My name is Paul Andreola. I, along with a gentleman named Trevor Terweek, run an organization called Smallcap Discoveries. And really what we do is we work to discover nanocaps and microcaps, predominantly in the Canadian public markets. It is an unfriendly market every now and then, but from time to time we find something that is worthwhile talking about. So let's see here. There we go. Okay, so what exactly do we do at Smallcap Discoveries? It's a discovery and stock picking process that we've defined over the last, I've been at this for about 30 years. Gained experience from being a private investor, been a broker, an investment banker, and also spent time involved in startups, both from founding companies all the way to taking them public. And currently sit on the board of a couple companies, so I've gained a fair bit of experience from being in all different areas within running a business, as well as capital formation around companies and financing these companies and eventually taking them public. But what we found over those 30 or so years is that if you're looking for success in specifically the microcap space, you can lessen the risk and increase your chances of success by sort of defining a small subset of criteria that allows you to get what everybody's hopefully looking for in the microcap space, and that's these multi-baggers. So I'll speak a little bit about the process as we go here. First off, okay, so what is it? What is this discovery process that we talk about? It is sort of discovering these early stage companies that typically are less than a $50 million market cap, but very undiscovered by the capital markets. Traditionally, companies get discovered either because somebody's promoting the business or an investment banker is helping raise money for a company. We're looking for those orphan companies that traditionally are making money, so don't need the capital markets, don't need the investment bankers, and are really not being promoted because they're just too busy, running their business. Why do we do it? Well, we do it because we can make money from it. It's been lucrative for us. I can sort of highlight a couple of the companies that we've discovered in the process a little bit later, but it is really an opportunity here to find significantly mispriced opportunities. And one of the other presenters, Matthew, earlier said something that really resonates with us. In the microcap and nanocap space, especially in Canada, a lot of times you are competing with inexperienced investors and sort of the unprofessionals. And we think we've got a big edge by sort of having a disciplined criteria within that market cap and in that space. So the process, what we do is it'd be pretty boring, but we go through every CDR filing. So every financial filing in Canada, we review that on daily basis, but we're looking at quarterly filings, and we're looking for companies that meet this criteria that we go through. So we don't use any automated screening processes. We don't use software. We literally manually go through every single filing in Canada. And, we can quickly look for the key things we're looking for and go through a number of companies very quickly. We do that on a regular basis, but also at least twice a year, we'll go through every filing A to Z to really discover, what we're looking for. So we do it the old school way, the old fashioned way. Who does it work best for? This really works best for smaller investors. Institutional investors cannot come down market. In some cases, we've bought stocks, with microcaps of less than $5 million. So, a small amount of capital being allocated here is actually an advantage as opposed to those with a larger amount of capital. It also works best for those that really understand that they're buying a business, or that's the intention. You have to have a longer term time frame. You got to be less, concerned with short-term price movements, and you also have to be prepared that in a lot of cases these stocks are very illiquid and they have very, very little exposure. And as far as the performance, we don't sort of track portfolio performance, but we can tell you that we've identified. I certainly have identified about at least half a dozen stocks that have turned out to be 100 baggers. And on a regular basis, we've discovered a lot of companies that are, the 10 to 20 bagger type of stock that hopefully everybody is looking for. Okay, so a little bit more about the process, a little more details here. When we do go through these CDR filings, we're looking for companies that are growing their revenues by at least 25% on a per share basis. Clearly, if they can grow faster than that, we're looking for that. But it's important that we're looking at it on a per share basis. We don't tend to get too involved with companies that are doing a lot of M&A and are growing their revenues, albeit they're also growing their share base. So we're looking for smaller share count, but a good revenue footprint from that share count. We're also looking for profitability. We're looking for early stage inflection points. So what we find is if we can see at least 2 quarters of profitability back to back, then we think we've got something that is not a one-off, and something that, at least with 2 data points, looks like it's the start of a trend. So we want to see this consistent revenue growth. We want to see profitability. Very, very few companies in Canada, certainly in the microcap space, are profitable. So immediately, that screens it down to about 5 or 10% of the available microcaps, probably even less. So we're looking for profitability, and then again, size. We're looking for companies that are under $50 million market cap. In the last couple of years, we've actually invested in a couple of companies that had less than a $3 million market cap. So we're looking at the real nano cap side of the market. Why are we doing that? Well, part of it is because, again, you're competing with inexperienced investors. Institutions are not down market, and ultimately we want to be selling to the more experienced investors in the institutions. So that's kind of what we're doing there. And on the side here, I mentioned sort of the process. We do go through CDR, and CDR, similar to Edgar in the US, CDR is where the repository for all the filings in Canada are placed. It's a very clunky system. We love the fact that it's clunky and unappealing, because it makes it a little bit less appealing to other investors to look in that and do what we do. Okay, so just a few of the names that we've found over the last several years. The one that sticks out the most is XPEL. I was fortunate enough that we discovered XPEL below 20 cents, and that's when we started building our position. That was a company that was growing very quickly, clearly still is. But back at that price, the company was growing its revenues by over 100% on a year-over-year basis, was trading at less than 10 times earnings. And very few people were following it. One of the other interesting aspects of that, why our system worked well, was because it was a US dollar denominated stock on a Canadian exchange. It did not show up very well on a lot of the software screening programs. So we were able to find it early, and a lot of others just simply didn't find it. But a lot of the other names there went on to be, in some cases, 100 baggers plus. So clearly, looking in this part of the market where we are, we can find some really, really good returns. Okay, so the company I want to talk about fits the bulk of the criteria that we look for. Company is called CPRO. It stands for Serial Advanced Processing. This is a life science / consumer product company. It's based here in Canada. It's located in Edmonton, in Alberta. They have a state-of-the-art GMP manufacturing facility that manufactures their own products. The products are sold. They're sort of components of some major household brand products. There's a good chance that you have some of these products in your shelves. Sold to major brands across the world, and really what they're able to do is they can process plant-based material and extract very high value products that are used in everything from sort of cosmetics nutraceuticals, and in some cases, biopharmaceuticals as well. Okay, so part of the reason we like this business is that there's really two components to it. One is the sort of the core revenue generating component of the business, mostly two products that are sold in the cosmetics industry. Very good, solid core business. The other key part, apart from this profitable core business, is the sort of the optionality, if you want to call it that, but the ability to generate new products and high value new products while being sort of funded through the existing and excess cash flow of the business. So, new and novel products that are coming to market that have the potential to be extremely high value, and in addition to the core products they have right now. Okay, so as far as the revenue trend, these are the sort of charts we like. We like to see them consistently go from bottom left to the top right, and that's what's been happening. The two core products generate the bulk of the revenue. As you can see here, it consistently going higher. Last year was a record year for them in terms of revenue and profit, and so far in the first half of this year, they're on track to have another solid record revenue a year, as well as record profits as well. A bit of lumpiness over the course of the last several years in terms of profit, but that is partly due to money being reinvested in the business and some of the high-profile products that are on the shelf right now that are hopefully going to get commercialized. Extra R&D being spent on getting those products advanced, and some of those products do include biotech or drug style products that are going through at this point mostly clinical or preclinical stage trials, but soon to be in the clinic, and potential for very, very high revenue from these products if they're successful. So a few details. Okay, so last quarter revenue grew by 25% over the year ago period. If you take the trailing 12 months, revenue grew by 29% over the last 12-month period. There is a little bit of lumpiness in some of their sales, but if you average it out, it's pretty consistent. Earnings or profit increased by 146% this quarter over the same period last quarter. We've now seen 6 quarters of consecutive profit, so there is some consistency here, and like I said, the trend continues to go in the right direction. Somewhat low issued and outstanding shares. The company has about 78 million shares outstanding. It's a little bit higher than we tend to like, but nevertheless, market cap still fits under that $50 million mark that we're looking for. Okay, so just a little bit more of the same thing I just mentioned, but the only real difference on this slide here is the insider ownership is just shy of 10%. We prefer to see an insider ownership that's a little bit higher. A little bit over 10% is kind of what we look for. So if anything, this one's got a little bit lower than we want to see. There are no warrants outstanding. As far as the cap structure, there are about 3.5 million. Here we go. There's a slide with that. 3.28 million options outstanding. So fully diluted, you're looking at about 81 million shares. Current price 72 cents. This is all in Canadian dollars, by the way. You can see the high low there. Market cap 45 million. But okay, so last year, trailing 12-month revenues, they did just shy of 19 million. Like I said, that was up about 29% from the year ago period. Profitability, 4.3 million in trailing 12 months, 6.6 million in trailing 12-month EBITDA. Very healthy balance sheet for a company this size, just shy of $9 million in cash, no debt. As far as yesterday's closing price of 72 cents, the stock trades around a 10.4 times trailing 12-month PE. And if you were to annualize this last quarter, you get your 6.8 times PE ratio. So that's kind of it. Like I said, really the piece we like here is the core growing business and the two main products that they have, which are both, by the way, oat-based products, ananthramides and oat beta-glucan. If you have Aveeno skin care products, if you have Neutrogena skin care products, a number of products from Jergens and Johnson & Johnson. These are all the brands that carry their oat-based products. So that's kind of it in a nutshell. But we like the business because it's got that good core, solid, growing business, and then the sort of call it lottery ticket generator with the new products that are going through the different phases of trials right now.